Okay, so let's jump right into this really fascinating puzzle from the world of finance. Honestly, it's a real head-scratcher, and it kind of messes with one of the most basic things we think we know about how business works.
You'd think it would soar, right? I mean, record profits? That sounds like a company that's absolutely crushing it, and investors should be jumping all over it. But what if the exact opposite happened?
Well, this isn't just some made-up scenario. This is exactly what went down with Reliance Industries, one of India's absolute corporate giants. They put out these amazing, record-breaking profit numbers, and the market's reaction? To sell. The stock actually went down. So what in the world is going on here?
All right, to get to the bottom of this mystery, first, we've really got to wrap our heads around the incredible scale of this company. See, Reliance isn't just big. It's operating on a level that's almost hard to imagine. For starters, get this. Reliance was the very first Indian company to ever smash through the 20 trillion rupee mark in market value. A number that huge, just to put it in perspective, makes it the 48th most valuable company on the entire planet. And its revenue? We're talking over 10 trillion rupees in a single year. That kind of number lands it at 86 on the Fortune Global 500 list. So it's right up there with some of the most famous brands in the world.
And, this isn't just about numbers on a spreadsheet. It's about real-world stuff that powers a whole nation. From these massive deep-sea oil and gas operations you see here, all the way to your phone service and the corner store, its presence in the Indian economy is just, well, everywhere.
Okay, now here's the crucial point. A giant company like Reliance isn't just one single business. Think of it more like a collection of really powerful engines. And that big headline profit number, it doesn't tell the whole story. To really get what's going on, we have to look under the hood. So here you can see how the company breaks down. These are its main divisions, and the chart shows how much each one contributes to its profitability. You've got the old-school oil-to-chemicals business, you've got the super fast-growing retail and digital parts, and a few others. So to figure out why the market reacted the way it did, we can't just look at that total number. We've got to see how each of these engines was running.
And boom, here's our first big clue. When we zoom in on the oil-to-chemicals business, which has always been the company's main cash cow, we start to see some dips. Production for key things like gas oil and paraxylene actually went down compared to the year before. And this really gets to the core of it. Even while other parts of the company, like its digital services, were absolutely booming, its biggest, most established engine was kind of sputtering. It was facing tough global competition, and its profit margins were getting squeezed. So yeah, the overall profit was a record, but deep down in the engine room, some warning lights were definitely flashing.
And this all brings us to probably the single most important rule in the stock market. It's not really about how well a company does. It's about how well it does compared to what everybody thought it was going to do. Think of it like this. The market had already given Reliance an A+ on its report card before the results even came out. But then the company came back with an A. Now, look, an A is fantastic, but it's still a letdown if everyone was betting on absolute perfection. The market doesn't grade you on reality, it grades you on reality versus what it expected. It all boils down to this simple idea. Good isn't good enough when investors expect great. That little bit of weakness in the main O2C business meant that the final number, even though it was a record, fell just a tiny bit short of those super high predictions. And in the ruthless game of market expectations, a miss is a miss, period. But here's the thing. While the market was busy reacting to that slight miss for the quarter, Reliance was already way down the road building its future. And this is where the story gets really transformative. The company is in the middle of one of the biggest pivots you'll ever see in the corporate world. It's pouring over 75,000 crore rupees into this massive shift, moving away from its old fossil fuel foundations and aiming to become a leader in green energy. It's a total shift from the past, like this fuel station, to the future, which is this huge new solar factory. And look, this isn't just some vague promise. It's a concrete, decade-long roadmap. The plan is to build these massive gigafactories for solar panels, for batteries, for hydrogen, all of it driving toward one single goal,
to be net carbon zero by 2035. It is a complete reinvention of the company's energy DNA. So what you have here is this classic tug of war in investing. The stock market is often completely obsessed with the short term, with this quarter's results, while the company itself is making these huge long-term bets that are going to define it for the next 50 years. And that really leaves us with the big final question, doesn't it? When a giant company is actively turning its ship toward a totally new horizon, does it really make sense to judge its progress by looking at the water it's leaving behind? It's the profit paradox, right there. And it's a great reminder that sometimes the real story isn't in today's numbers, but in the vision for tomorrow.